Good morning, Henry Becker here. Today is Tuesday, March 22nd. My topic for today is history. I was a history major in college, and one of my most favorite quotes is from George Santayana. His quote was, "Those who do not remember the past are condemned to repeat it." It's a very useful quote just to keep in mind, I think, because obviously if you don't remember what's happened in the past or you've not studied or understand the past, it's likely that you might make the same mistakes that have been made in the past. But part of the problem now with investing in the stock markets is that the past is not quite as useful as it once was, and the reason for that is, we are living in unprecedented times in this country, which, and what I'm talking about is debt levels, weakness in the dollar, global instability. All of these things have happened in the past, but right now we've got them all happening at once. And that is, the weakness of the dollar. The dollar's hitting multi-decade lows versus foreign currencies. The U.S. has taken on massive amounts of debt, unprecedented amount of debt, at least for this country. And quite frankly, there's very few countries that have generated this much debt, if anybody. So the point is, when you're living in times like this, typically from an investment standpoint, a lot of the rule of thumb, general advice, it's garbage. The garbage you see on the internet and that you hear from the propaganda doctors from Wall Street is, having money in bonds, having money in stocks, having money in real estate, basically throwing it against the wall, it being, and seeing what sticks or what gives you a profit. And that's the whole idea of diversification. And diversification in and of itself makes sense, but you don't just put money in certain places and hope for the best. Diversifying in areas that look like there's going to be improvement or that actually run counter to one another makes sense. Putting money in bonds just because historically bonds have acted differently than stocks isn't necessarily a good reason today to do such. And the reason I say that is if you look at U.S. Treasury bonds, the problem is we're at record low interest rates and we're looking, we're looking at significant inflation down the road. Quite frankly, it's already here. I've gone on about, or I've written about and talked about, inflation isn't rising prices. That's the effect of inflation. Inflation is the expansion of the money supply. That's already happened, and it's still happening. And we're now starting to see inflation in prices, right? The effect of inflation is rising prices. We're seeing that in a significant manner. So the point here is just because history shows, well, you want to have bonds and stocks, that's not necessarily true. Because where risk lies today is right here in the United States, in the U.S. dollar, in bonds, which most people have run to as a safe haven, in the destruction of the equity market in 2008 and part of 2009, bonds got a lot of inflows. So the problem is when you see outflows from bonds, that reduces the price of bonds, sends up yields, right? Interest rates. The other problem is as interest rates rise, it's self-fulfilling. People want to get out of bonds. So there's more selling. As we see inflation, again, inflation is a pressure on interest rates to rise. Bonds are probably one of the worst places to be right now. Even if you see, the short-term sell-offs, bonds might pop a little bit, but it's going to go away as soon as there's any snapback in stocks. So the point here is using history as the guide, looking at, well, historically, stocks and bonds have run inverse of one another. Well, history isn't so much useful right now because the past is the past. A lot of what made the past useful as an investor is now broken. And what I use as an analogy for some of my clients, or I'll draw pictures, is a teeter-totter, which is what you used to see, or a seesaw, whatever you want to call it, where when stocks are up, bonds are down, and vice versa. That's what people will show you. They'll also use the same thing for interest rates. When interest rates are up, prices are down on bonds. When interest rates are down, it's vice versa. So the point here is a teeter-totter only works, or a seesaw only works, if the fulcrum, right, the triangle in most pictures, that you have the fulcrum and the teeter-totter that goes up and down. If the fulcrum is broken, the teeter-totter doesn't work. period. It's just impossible to work. So the fulcrum is broken. The foundation of what made stocks and bonds, that relationship work, the inverse relationship work, that's broken. And if that's broken, then the whole idea of up, down, stocks, bonds, it just doesn't work anymore. So, like I said, in the short term, you might see where that inverse relationship works, but over the long term, bonds are not going to be the place to be, and even over the medium term. And I think that long term is getting closer and closer. The more debt we're taking on as a country, the more inflationary pressures that are coming into the United States. So the point here is you don't want to use those rules of thumb. You want to look at real data today. You want to look at correlations, how things work opposite of one another right now as we speak, maybe in the last 12 months, correlations. You want to look at maybe on a really bad day in the market, look at what went up. Look at what currencies went up. Right? It might not be the US dollar anymore. It might be the Swiss franc. It might be one of the emerging market countries. Their currencies have a stronger day on the really ugly days in the stock market. So the point here is look at what you're investing in. Look at your portfolio with a very critical eye of current situation, not a critical eye of what history has shown. So that's my spiel on history for today. Like I said, take a look at correlations. If you want a good website for exchange-traded funds to look at correlations, you can look at, I believe it's www.etfscreen.com, or if you just put in a Google search for etfscreen.com, you'll find this website is very handy in showing you correlations of ETFs to one another. So that's it for today, and feel free to check back soon. I'll put up another post.